A lot of people are looking at their portfolios and they're noticing that growth stocks have had a huge run in 2023 based on history and what's going on in the economy. Growth stocks is where you want to tilt going forward. So let's get into this really great macro study. So why do we believe growth stocks still have legs? Well, there are 5 themes that you should be aware of. The first is Fed tightening. Everyone knows interest rates, they continue to climb. They are really choking off the cost of capital, okay? People are not getting loans right now. And so that means that it's slowing the economy down. And that means people are worried about a recession. The Bloomberg consensus forecast for 2023 GDP, it's only at 1.2%. For 2024, it's at 0.8%. People are concerned. But here is the deal and why it is bolded. When growth is scarce, we're talking about economic growth, investors pay up for growth, namely growth stocks. We're going to get to that in a moment, but let's first cover the reasonable valuation. The S&P 500 Growth Index, currently it trades at a 26% premium to the value index. That's roughly in line. 22% is the 20-year average. And then this is also something that people are not aware of. Value stocks, they are very sensitive to the economy. If there's a downturn, they are not going to perform well. They actually accelerate whenever the economy is coming out of a recession. And that's not what we're talking about in this climate. So check out this awesome chart. It is showing how growth outperforms when the economy is weak. So the blue bars, that's S&P 500 Growth Index. The gray bars, that's the Value Index. Let's look at a few facts. Going back to 1980, when GDP is less than 2%, growth leads 69% of the time. When GDP is worse at 1.5% or less, growth leads 60% of the time. This is the most important key. When GDP grinds to a halt and it is less than 0.5%, growth outperforms 100% of the time. And you can see that right here with that big, beautiful blue bar. That is what you can expect whenever there is no growth, because usually shortly after, the economy does start to kickstart afterwards. The lower the growth rate, the more growth outperforms. So, which sectors do you want to overweight for this play on growth? Well, the S&P 500 Growth Index, huge weighting in tech versus value. Also, it's got a huge weighting in healthcare, which is really going to come into effect whenever the economy is weak. We all know people are going to spend on healthcare no matter what the climate. So let's go ahead and compare the S&P 500 growth and value sector weights. So tech is 1/3 of growth versus 17% of value. Healthcare, believe it or not, it's nearly 20% of the portfolio versus about 10 for the value group. Here's the other interesting part is energy is 7.5% versus less than 2% for value. Now, Alec really likes energy, and that's because crude has really come down. He sees that this is probably a tactical bullish play on the group right now with crude where it is. I think also most important though is look at the bottom of the barrel. Some of the weakest performing groups this year have been real estate, industrials, and financials. Those are very lightweights in the growth sector. Compared to value, those are big chunky weights. So if you're worried about the banking crisis, value is not where you want to be. What do we want to do? We want to look at the highest ranked groups in the map signals data. Discretionary and technology have been the bellwethers, and for good reason. They have some great companies in them, and a lot of them, they're in a very strong uptrend. You can see the fundamental and the technical scores are very, very healthy. So now how do you play it? Well, there is an ETF that tracks the S&P 500 growth, and that is SPYG. Ticker is SPYG. It's got $7 billion in assets. And Alec likes this versus SPYV, which is the S&P 500 value ETF. Now, there is a MAP score of SPYG of 68, which is actually pretty darn good compared to only 59 for the value ETF. Another reason he likes SPYG is because it's got a 44% weighting in mega cap blue chip tech and discretionary stocks like Apple, Microsoft, Nvidia, Home Depot, Starbucks, Nike, and Amazon. Full disclosure, I own Microsoft, Home Depot, Starbucks, and Nike. But again, you want to stick with quality when times get tough and don't give up on your growth stocks. You guys find out more information at mapsignals.com. And always remember, follow the big money. I'll see you guys next time.